Good morning and welcome everyone to our weekly market update with Ashworth Wealth. Today is March the 6th, 2023. We're delighted to have you here with us. And we will go ahead and jump right in. The market last week on Friday had a fairly good pop. It was primarily because one of the Fed officials indicated that the next interest rate raise may not be as aggressive as maybe what the market was thinking that it was going to have to be. It still will be 25 basis points, according to this one Fed official, but may not have to be as aggressive as 50 basis points, which some people were a little bit worried about. So I want to talk about interest rates here for just a minute and show you a little bit about what has happened just recently within the last month. What this chart is showing here is that the difference of what it's called implied volatility. And what implied volatility means is the Fed is saying one thing, but this is what the market is pricing into the market based upon what they think the Fed will actually end up doing. And you can see these different dates here. Here's February 1st, February 3rd, February 15th, February 24th, and then last week, February 3rd, or March 3rd, excuse me. And you can see here that on the 1st of February, we can see that the market was pricing in a couple of additional increases here before the end of the year. And then by the end of the year that we were going to start tapering a little bit and have a lower rate than what we started with at the beginning of the year. All of these iterations here that you can see, the 3rd, the 15th, the 24th, you can see the 3rd, you can see the 15th, you can see the 24th here. And all of them are just a little bit higher, indicating that they feel like that the reporting that the Fed is seeing with regards to the economy is still quite a bit stronger than people anticipate. And so they're trying to kind of guess what the Fed's going to do. It's one thing based upon what they're saying. It's another thing based upon what they actually do. And it is going to be market driven. And so they're allowing the markets to kind of dictate what their this implied policy rate is. But you can see that the latest as of last week, you can see here that the policy rates it looks like are going to continue to increase. This is what they call the terminal rate. The terminal rate is, for all intents and purposes, is just the highest rate that it will go to. And you can see here that it's staying there for a quarter and then inching down a little bit as far as the implied volatility. Couple of interesting things that are happening right now. One of the things is that the jobs report that was coming out from the government, there was an article on that today indicating that they don't feel like that the government is, that it's not that they're trying to be deceptive, but it's just that they don't feel like that the government's reporting mechanisms are as accurate as they need to be with regards to the jobs report. They're reporting very, very, very strong jobs report, but as many of the investment managers and other economists are polling people and kind of looking at companies and what they're doing, the data that they're getting does not match, or currently isn't matching, the data that is being generated by the government. One of the problems that they've identified is that one of the ways in which they do the jobs report is to do a survey. They just call a whole bunch of people and say, are you employed or are you not employed? And they call companies and they call various people, and these surveys are what they use to dictate the reports that they send out. The interesting part of that, however, is that on these job reports that they're sending out, the percentage of people that are participating in them that they actually reach out to has dropped from 65%, somewhere in that range, down to only about 35%. So it's been cut almost in half, and they're suspecting that a lot of the discrepancy in those job reports is coming specifically because people just don't want to do surveys anymore. So anyway, it looks like we're going to continue to have some good volatility in the marketplace. We had a good little pop last week. A little bit of a relief rally. We anticipate that it'll still continue to just be up and down for the time being, but we will stay and keep you in touch and we will continue to do these weekly market updates. And thank you for joining us. We appreciate your business. We appreciate coming and looking at our podcast. And we will let you go for today. Thank you so much.